The first thing you're going to want to do if you're looking at a government's pension and OPEB plans is to find out how much the liability is. It's the obvious first question. And you may, in fact, be able to find it on the face of the government-wide statement of net position, but likely you won't because most governments don't, as in this example, show their long-term liabilities by type. They generally show them aggregated in this manner, uh, in two lines, the portion due within a year and the portion due beyond a year. So within this line, due in more than 1 year, are all the long-term liabilities, the portion due beyond a year, plus the net pension liability and ultimately the net OPEB liability, all of which is due beyond a year. None of it is considered to be current. So you're going to have to go look at the notes to the financial statements to find the amount of the net pension liability or the net OPEB liability. That's where you're going to find the numbers. You will always find them there, even if they are shown on the face of the statement of net position. So let's take a look at those note disclosures because that's where you're going to find most of the information you use to analyze pensions and OPEB. The disclosures will start with basic descriptive information about the plan, what the name of the plan is, who administers it, what types of benefits are provided and who they're provided to, whether the plan issues a financial report of its own. If it doesn't, then the reporting required for the plan will be reported by the employer as well, hopefully without duplicating too much of the overlapping information. But in many cases, the plan does issue a report of its own that you may want to look at, and the employer's note disclosures will tell you how to get a copy of it. You're going to see what the contribution rates are of the government and of its employees, and a lot of other basic information about the plan. Governments in single and agent plans will provide a disclosure of the number of members of the plan presented by in three groups at a minimum: inactive members who are receiving benefits, inactive members who are not yet receiving benefits, and active employees. In this particular example here, they've provided voluntarily some additional information below the inactive members line. Every government should disclose what its contribution policy is. It's not always going to look this detailed, particularly if they are in a cost-sharing plan where their contributions are probably based upon either a state law or based on a contract with the plan. But if they have actuarially based contributions, then you will see a little bit more information. But it could be as minimal as them saying our contributions are based on actuarial calculations without providing this detail about the assumptions that go into determining those contribution amounts. If that's the case, you will definitely see them in one of the supporting schedules related to actuarially determined employer contributions, and I'll say more about that in a little bit. You will see a disclosure about what the measurement date was, as well as the date of the actuarial evaluation, and if they used updating or roll forward procedures to capture things that occurred between the actuarial evaluation and the measurement date, they will tell you that they did that as well. There are very detailed disclosures related to the long-term expected rate of return and the discount rate. Among those is a breakdown of the portfolio of the plan by asset class and a disclosure of what their expected rates of return are, real rates of return, meaning adjusted for inflation for each of those classes. So this is not just saying we chose 7.5%, but they really have to explain how they arrived at 7.5%. And a part of that is sort of building up to that by showing you, for each of these parts, and here's how big a portion of their portfolio is in these different types of assets, different types of investments. Here's for each of these what we are expecting the rate of return to be. If a government does some or all of its discounting using a municipal bond rate, it will tell you what that rate was and where it, and the source of the rate. In the case of a government with a crossover, they're going to tell you what the single discount rate is, but they're also going to provide some disclosure about what years the long-term expected rate of return was used to discount and which years were discounted using the municipal bond rate. And you can see here that for this government, up through 2035, they discounted the projected benefit payments using the long-term expected rate of return. And from 2036 and beyond, they discounted using the municipal bond rate, which in their case was 4.35%. And then the single discount rate that would have produced the same actuarial present value as using the long-term expected rate of return to 2035, and the municipal bond rate beyond that was 5.23%. They will also explain what assumptions went into projecting the fiduciary net position of the plan, what the value of assets would be. Governments aren't allowed to assume their way into having no crossover point. And by that I mean, if they traditionally haven't been paying an actuarially determined amount that would get them to full funding, theoretically, eventually, they can't, for the purposes of projecting fiduciary net position, assume that they're going to start contributing an amount they've never contributed before. So it should be based upon what their actual experience is, and so they will explain to you what assumptions they made about their contribution policy going forward for the purposes of projecting fiduciary net position to determine if they have a crossover point or not. This is the disclosure that I mentioned earlier, where they show here's the net pension liability using the discount rate. This government doesn't have a crossover point, so it discounts all of its projected benefit payments at its expected long-term rate of return, which is 7%. In this disclosure, they have to tell you what the net pension liability would have been if they had used a 1 percentage point lower discount rate and a 1 percentage point higher discount rate. And one thing you can do with this is calculate percentage changes between these to get a sense of how sensitive to the assumption of the discount rate the calculation of the net pension liability would be. And you see in this case, a 1 percentage point reduction in the discount rate almost doubles the net pension liability. And a 1 percentage point increase using 8% instead of 7% reduces it by over 80%. So this is very highly sensitive to it. Here's an example where it's not quite as sensitive. The difference here is a 38% increase or a 36% decrease. Now, what is the difference between these two that I've just shown you? This is something interesting that we've found in looking at note disclosures from governments that have implemented the pension standards, is that the better funded the plan is, meaning the larger the assets are relative to the total liability, a number that can go up to 100%, meaning it's fully funded, or as low as 0%, meaning there's no assets at all. The closer you get to 100%, the more sensitive the measurement is to the measurement of the net pension liability is to changes in the discount rate. And so, if you were to graph them out, as I did with a sample of about 50 or 60 governments, you can see that this is the so here's the asset sufficiency ratio over here. Can go up as high as 100%, and these are the percentage changes over here. So the closer you get to, when you start to get to close to 80% and higher and 90%, the percentage change in the net pension liability starts to skyrocket. Up to this point, it's still less than 50%. When you get up here, it gets up to this 100% change, so a doubling, 150% change, so it increased 2.5 times. That's an astounding trend, and so I think it probably means that we would have been better off requiring a disclosure of the variation in the total pension liability. And if you did that for the same governments, you could see this is a much more predictable and straightforward direct relationship. You can probably mold a line right in here that would show you the relationship. Still, the better funded it gets, the higher the percentage. But we're talking about a range from 5% to less than 20%, as opposed to a range of 5% to 150%. So if you wanted to do that, it's relatively simple. Using the example before, all you have to do is add the fiduciary net position to the net pension liability in this disclosure, and it's going to be the same. It doesn't change because of the discount rate. So you add it to each, and that gives you the total pension liability, and then you can calculate the percentages there. And that's probably a more meaningful number for comparative purposes, I think, than the percentage change in the net pension liability. This is one of the newer, another of the new disclosures, and it's presented by single and agent employers. It's not presented by cost-sharing employers because the information would apply to the entire plan and not just to them. What this is a disaggregation of the causes of changes in the net pension liability from the beginning of the period to the end of the period. So this is the number that this government would have reported in its statement of net position, $81,979,000. It started at 97 million and change at the beginning of the period, and these are the things that changed it. Service cost, and that's the same thing as normal cost, the cost of the benefits newly earned, interest on the total liability, the effect of changes in assumptions, contributions to the plan, increased fiduciary net position, which lowers the liability. Net investment income increases fiduciary net position, which reduces the net liability, and so on. Benefit payments reduce the total liability. They also reduce the amount available in the plan, so they don't have a net effect on on the net pension liability. So this is really potentially valuable information showing you what's driving changes. Did it increase or decrease, and why? And you have the possibility of calculating a lot of different ratios from this information. First and foremost is the asset sufficiency ratio, which is showing the degree to which the assets in the plan as of the measurement date are sufficient to pay for the liability. And so what you do is you divide plan net position by the total pension liability, and in this case it gives you a ratio of 83%. That's a pretty decent ratio compared to a lot of plans. Ideally, you want to be at 100% or close to 100%, but because of changes in market valuations of assets, changes in the liability over time, economic factors, even a well-funded plan is going to fluctuate below 100% much of the time. But something in the 83% range, is pretty decent, although it could be better, obviously. Some of the other things you can do here is look at the sufficiency of the inflows that are going into the plan to cover the major outflows of resources and the major things that are driving increases in the liability. And so, the two that you can always count on every year to be a sizable increase in the liability are service cost and interest. So what you might do is look at the employer's contributions and to the plan and see whether they're sufficient to cover those things that are increasing the liability. In this case, you can see it's roughly equal to 41%. And you can play around with what's in the numerator and the denominator. So let's do all of the contributions. If there were contributions from a non-employer contributing entity like the state government, you could include those in the numerator as well. Still with the service cost and interest in the denominator, that ratio comes out a little bit higher, a little less than 54%. Maybe you want to include all the major inflows, so you include net investment income as well, and that comes out to 160%. This happened to be a very good year, for returns. If you look at, almost $55 million in net investment income off of a base of $344 million. This happened to be a very good investment year. The following year, after this particular year, was not a great year, and this number would be a lot smaller and possibly even negative. There might have been a net loss in income over the year. So what do these three ratios mean? That really depends, and it it remains to be seen because we've only got 1 year's worth of experience with it. And so I think ultimately we'll need to try a lot of different ratios and measure them over time and see which ones are the best predictors of, of financial health in these pension plans. Certainly, if you're looking at these two, the difference between them speaks to the balance between the portion of the liability that's being covered by employer contributions versus employee contributions. And if that gap grows over time, that suggests there's a shift from the employer to the employees in terms of responsibility for financing, or vice versa. Those numbers, those first two ratios, are likely to be relatively constant over time. They may increase or decrease, but not dramatically. Whereas this one, because it includes investment income, which can go up and down, pretty significantly from year to year, it's relatively volatile. So this ratio may change quite a bit. The third one from year to year. The next year, this could be under 100%. What governments in cost-sharing plans present as an alternative to that is a note disclosure that tells you what their proportion is, their percentage, and what their proportionate share of the net pension liability is. All governments will present a disclosure that tells you what their pension expense was for the year. And then they're also going to take, you may just see these deferred outflows and deferred inflow numbers, maybe this one on the, in the aggregate, or even aggregated with other deferred outflows, and maybe this in the aggregate or aggregated with other types of deferred inflows. At any rate, what you're not going to see until you look at this note disclosure is what each of them is related to. So here's a deferred outflow related to changes in assumptions. Remember, I told you that gets introduced into pension expense over the average remaining service period of the members of the plan. Here's a deferred inflow related to the net difference between projected and actual earnings on plan investments. That gets introduced into pension expense over a 5-year closed period. Here's a contribution made subsequent to the measurement date. So that is reported as a deferred outflow. Next year, it will directly reduce the net pension or net OPEB liability. What isn't here is any deferrals related to experience gains and losses, differences between assumed economic and demographic factors and what actually occurred. The other thing you see in this disclosure then is taking these deferred outflows and deferred inflows in the aggregate. Here's how they're going to affect pension or OPEB expense over each of the next 5 years, and then all years in the aggregate after 5, so 6 and beyond. And as I told you before, that most of the average service periods I've seen, average remaining service periods, have been between 5 and 10 years. So at most, this is probably an aggregation of 5 years or fewer. But you can see that the combination of these deferred outflows and deferred inflows is going to net against pension or OPEB expense by about $3.8 million for each of the next 4 years. It's going to add to pension expense, by about $1.6 million in 2020. And that's just on top of all those things that are recognized in pension expense immediately, like service cost and interest on the total liability. The schedules that are presented as RSI, every government's going to present 2 of them. For governments in single and agent plans, they're going to ultimately present a 10-year schedule that shows that right-hand column from the note disclosure that shows changes in the pension liability. So you're seeing, here are the things that changed for 2015. And here's that example. I mentioned this earlier, where it really is 2015, but for some reason a lot of governments are calling it 2014. Probably because that was the measurement date, but showing the changes in that year in the total pension liability, in fiduciary net position, and then the aggregate change in the net position, the net pension liability for this government. What you will also see, either in the same schedule or in a separate schedule, are a couple of ratios. These are the basic ratios of analysis for pensions and OPEB. The first is an asset sufficiency ratio. It's the fiduciary net position the ending fiduciary net position divided by the ending total pension liability. And this government has a 92% funded plan. That's really very good. Then you will see covered payroll, which is the government's the total amount of its payroll on which its contributions to the plan are based, and then a second ratio that is the net pension liability. So this number here, 29.2 million, divided by covered employee payroll, and in that case, it's 29%. And the purpose of both of these ratios is to allow you to, first of all, evaluate the health of the plan, but also to make comparisons with other plans. And I'll say some more about that in the final section of this lecture. For governments in cost-sharing plans, they're going to give a 10-year schedule that shows their proportions and their proportionate shares of the net pension liability over the last 10 years. So you'll get to see if those are changing and by how much. They'll present their covered payroll and then present a ratio of their net position, their net pension liability, divided by covered payroll. So a similar comparable ratio to what we just saw for single and agent plans, and then an asset sufficiency ratio for the plan as a whole. So using the plan's fiduciary net position and dividing it by the collective total pension liability for all participating governments in the plan. This number wouldn't be available for the individual governments that participate in the plan because it's a cost-sharing plan. In addition, each government is going to present then a schedule related to its contributions. And I mentioned this earlier, for governments that have actuarially determined contributions, which is going to be mostly governments and single and agent plans, for the past 10 years they will show what their actuarially determined contributions were, how much they actually contributed, the difference, if any, between those two, their covered employee payroll, so the same number as the previous schedule, and then a percentage of their actual contribution divided by covered payroll right here. The purpose again here is to give you a sense of the magnitude, how big their contribution is, and something that you can compare with governments of different sizes. And it's interesting, just looking at this particular example, that they started this 10-year period out with a ratio of 11%, and it more than doubled to over 25% by the end of the 10-year period. And you can see the reason for this. Their covered payroll increased by 34% over that 10-year period, which really isn't much in terms of growth in personal services spending for a government over a 10-year period. But look at what happened to their contributions. Their contributions tripled. They went up by over 200%. So you could see why that ratio grew so quickly, because the contributions to the plan grew by 200% compared with just 34% for the covered employee payroll. So it represents a much bigger percentage of their payroll than it did 10 years ago, which means it must be a greater financial burden on the government than it was 10 years ago. I mentioned this earlier when I was talking about the contribution policy, that if a government presents a schedule of actuarially determined employer contributions, they will also present a note to that schedule that provides some information about how those actuarially determined contributions are calculated, basically talking about the assumptions and methods that go into it, retirement ages, mortality tables, what their assumption for inflation was, so on and so forth. For governments in a cost-sharing plan, they're likely to have contributions that are determined by statute or by contract with the plan, and so what they will show is their contractually or statutorily required contribution, what they actually contributed, the difference, if any, their covered payroll, and then a ratio of their required contributions divided by covered employee payroll. Very quickly, let me talk about the old OPEB standards, and I'm going to really go through this pretty quickly. The thing that is called the total pension liability under the new standards, under the old standards, was calculated with some different parameters around the assumptions and methods that could be used. They have a lot fewer choices under the new standards than they did under the old standards. And that total pension liability, the amount of the actuarial present value attributed to past periods, was called the actuarial accrued liability, or AAL. Rather than fiduciary net position, governments reported something called the actuarial value of assets, which was a smoothed value, generally over a 3 to 5 year period. So rather than being what the actual fair value of the plan's assets were as of the date that the liability was measured, it introduces the annual increases and decreases in the value of the plan's assets gradually, and for most governments it's somewhere between 3 and 5 years. As a consequence of this, and I'm not going to go into too much detail, but it used to delay the visible impact of dramatic changes in the market. So like after the market crash in 2008 and the prelude to the Great Recession, it was more than a year before you started to see the impact of the loss of value in plan investments in the ratio of the actuarial value of assets to the actuarial accrued liability, what was called a funded ratio, and is comparable to the asset sufficiency ratio because of the smoothing of the actuarial value of assets. It was 2 years before you really started to see most of the impact of that. And in fact, in that first year after the Great Recession started, a lot of plans were still introducing the increases in the fair value of their assets from prior years, and so they were looking better funded than the year before, and that obviously is counterintuitive when you know that a lot of these plans just lost 20 to 25% of the value of their assets in the market crash. The difference between these two is the unfunded actuarial accrued liability, or simply the unfunded liability, or UAAL, and that number was not recognized on the face of the financial statements like the net pension or net OPEB liability is. It was disclosed in the notes to the financial statements. Pension and OPEB expense were based on this thing called the ARC, or the annual required contribution, which was composed of two pieces. One was the normal or current or service cost, so the cost of newly earned benefits, and the other was an amortized portion of the unfunded liability, which could be spread over a period of up to 30 years. So it was effectively 1/30 of the unfunded liability plus the normal cost or service cost, and that was the ARC. And generally, if governments were contributing an amount equal to the ARC to their plans, that's the amount that was being reported as pension or OPEB expense. If a government was contributing less than the ARC, then it would start to accumulate a liability on the face of the financial statements called either the net, would have been the net pension liability for the pensions, in this case the net OPEB obligation, or NOO or NOPEBO, which is equal to the cumulative under contribution, so the amount that they've actually contributed less than the ARC ever since they first implemented the OPEB standards in the late 2000s. Of course, if they were over contributing, then they would report a net OPEB asset on the asset side of the statement of net position. As I said, the OPEB expense, if they're contributing the ARC every year, equals the ARC, but if they have if they're reporting a net OPEB obligation or a net OPEB asset, then they need to make certain adjustments to avoid double counting, because with subsequent actuarial valuations, the actual amounts contributed get incorporated into those valuations. So the number, the ARC, once it's adjusted, is then referred to as the annual OPEB cost, and that's the amount that is reported as OPEB expense. There was a lot of, under the old standards, a lot of descriptive disclosure about the nature of the plan, the types of benefits that were provided. In addition to that, they would disclose what the annual OPEB cost was and the dollar amount that was contributed to the plan for the year. If they have a net OPEB obligation, they disclose how annual OPEB cost was determined, meaning the ARC and then the adjustments and then the annual OPEB cost, the amount of the net OPEB obligation and the change from the prior year. For the past 3 years, they will show what their annual OPEB cost was and the percentage of that was actually contributed. And if they have a net OPEB obligation, they'll show that as well. Single and agent employers will disclose the following about their OPEB, the AAL, the actuarial value of assets, and then the unfunded liability, and then a funded ratio, the ratio of the value of assets divided by the total liability. It's comparable to the asset sufficiency ratio under the new standards. They will show covered payroll and then a ratio of the unfunded liability divided by covered payroll. As I alluded to earlier, under these old standards, if you're a cost-sharing government in a cost-sharing plan, and admittedly there aren't a lot of cost-sharing OPEB plans, most of them are single employer plans because there is no trust, no accumulation of assets. But if they are in a cost-sharing plan, they disclose a lot less information. They don't disclose any of that information about the size of the liability because that information isn't available for them individually. It's only available for the plan, and there was no requirement for them to figure out their proportion and their proportionate share. For most governments, you will see in the RSI a funding progress schedule that shows you, depending upon the circumstances of the government, it's mostly for 3 years. This government happened to show 4, although it's not required to. It'll show the actuarial value of assets, and as you would expect for most OPEB plans, there are no assets. The actuarial accrued liability, the difference between those, the unfunded liability, which in this case the numbers are exactly the same. Their funding ratio is 0 because there are no assets. Covered payroll, and the unfunded liability divided by covered payroll in a ratio here as well. So I've already alluded to quite a bit about the things that you will look at to analyze pensions and OPEB, and the key ratio that most people look at is the asset sufficiency ratio, or what used to be called the funded ratio, which is fiduciary net position divided by the total liability, or for the old OPEB standards, the actuarial value of assets divided by the actuarial accrued liability. Ideally, you want this number to be 100%. You want it to be fully funded, but it's, as I mentioned before, just normal changes in the economy from year to year are going to cause that ratio to fluctuate, and other things that cause the liability to grow or to shrink will affect that as well. So your goal is to get close to 100%, and the higher that number generally, the better funded they are. The other major ratio is this covered payroll ratio, where you see the net liability divided by the covered payroll, or under the old standards, the unfunded liability divided by covered payroll. And the idea here is to give you a sense of how big is this number. If you're looking at 2 governments and one of them has a net pension liability of 10 million and the other one has a net pension liability of 100 million, does that necessarily mean that the government with the $100 million net pension liability is worse off because it owes more? You really need something to put it in context, to common size it like a percentage distribution. And so dividing it by their covered payroll gives you a sense of how big it is relative to their overall financial activity. So if you've got a ratio, like we just looked at that OPEB schedule, and it was showing a ratio of the OPEB, the unfunded liability to covered payroll of like 400%. I mean, 4 times the total payroll related to OPEB. So 4 years worth of payroll would be required to catch up with that liability. That's obviously a very large amount. But it's a number that you can compare with other governments. If another one has a 200% or a 100%, the higher that number is, the more difficult their position is, the more difficult it will be for them to raise the resources necessary, or the more sizable the resources they need to raise in order to satisfy that liability. And then the other ratio using covered payroll is looking at the actual contributions divided by the required contributions. And, especially if you're looking at actuarially determined employer contributions, if those are calculated honestly, and by that I mean with reasonable methods and assumptions, really designed to, if they contribute that amount, get them close to or at full funding over the long run, then looking at this ratio and seeing if they are in fact contributing that amount every year is really valuable. It'll tell you whether they're keeping pace or not. And if they're falling behind, it's that's a potential warning sign. If they're contributing a percentage of less than 100% of the actuarially determined contribution. And giving you the percentage of the covered payroll gives you a sense of how big a financial burden that contribution is for the government. So if for one government it's 10% of their covered payroll and another one it's 20%, it's a bigger burden for the government with the 20% ratio. Another thing you can look at, and you want to use this ratio with caution, and it's called a depletion ratio. And what you're doing here essentially is assuming no more money is going to go into the plan, and so how long can they continue to make benefit payments with the amount of assets they have on hand, which obviously is not realistic. They're going to continue to have investment earnings. The government's going to continue to make contributions. The employees are going to make contributions, and so on. So they will be adding assets to the plan. But it's an interesting exercise to go through. And in its simplest form, you're taking fiduciary net position and dividing it by total benefit payments. So if you were to look at, at a particular plan, and here's from a few years ago, the retirement system of the state of Illinois, which is a particularly poorly funded plan. So one that you would think on the whole would probably deplete its assets faster than most. You want to take the total benefits for the year and divide those into the fiduciary net position of the plan, which gives you a depletion of 7 points. So in a little more than 7 years, if no more assets went into that plan, they would run out of money. That's pretty low. And that's a reflection of how poorly funded the Illinois plan is. You would expect to see that much higher. But this is a ratio that you can track over time, that you can compare with other plans, that gives you a basis for making a judgment about their financial situation. Now, if you wanted to do this a little bit more realistically, then you could project out what the inflows and what the inflows into the plan would be over time. And actually, a shortcut to that would be if you can get the government to give you that schedule that I showed you where I was explaining the crossover point. So their projections not only of benefit payments, but also of what their fiduciary net position was going to be, then you would the crossover point essentially is the depletion date. And that would, without having to do any calculations, you could see whether they actually have a depletion date or not, and if they do, how far off it is. So really, you shouldn't have to do this calculation anymore, unless, of course, the government doesn't want to give you that schedule, and they certainly don't have to. But they do have to disclose if they have a crossover point and when it is. And so, even if you can't get the actual information, you're at least going to be told if they have a crossover point. Now, the other thing you need to be mindful of with the crossover point too is that there's an assumption that goes into that as well, which is that the fiduciary net position they're projecting is that related only to the members of the plan as of the measurement date. And it doesn't take into account new members that will come into the plan and contributions related to those new members. So there will, in fact, be more assets in those plans than what is reported as fiduciary net position because it will relate to new employees. But for the purposes of doing this, you don't want to include them because they're not a part of the plan yet. But it would be wrong to say that at the crossover point, they won't have any assets left in the plan. They will, They just won't have any assets related to the current employees left in the plan, which maybe is a distinction without a difference. Another thing you might want to look at, and we're not going to get to this for another couple of lectures where we start to talk about investment risk, but it's worth taking a look at what types of assets the plan holds and making some judgment about the risk associated with that. I think a lot of people will tell you that pension plans are taking greater and greater risks over time because it's getting harder and harder for them to generate a sufficient investment income to make the benefit payments that need to be made. A lot of governments will manage that investment return in order to minimize the amount that they have to contribute because it comes out of their annual budget. They want as much of the liability to be covered by investment earnings as possible and as less as possible to be actual contributions from the government. And so more and more governments are having to get into more exotic investments. Maybe exotic's not the right word, but what is generally called alternative investments, things that are not traditional investments. And so looking to see what they're investing in and whether those are risky or not, is something you may want to look at. When we do talk about risk disclosures, then you can look at the disclosures related to the plan's investments a little bit more knowledgeably to understand whether there are substantial risks of loss associated with those assets. And of course, if they lose the value of those assets or lose them entirely, it reduces their funded status and they're not as well positioned to deal with the obligation to provide those benefits in the future. Just a couple of things to be mindful of. Even after the narrowing of the methods and assumptions that can be used to measure the liability in the new standards, there's still, governments still have the ability to make choices relative to their particular circumstances. So their discount rates may be different because their earning experience in their plans are different. And so these things can cause a lack of comparability. So even though they're much more comparable, the measures that you see under the new standards than under the old standards, you do still need to show a little bit of caution, I think, to be sure that you're not comparing apples to oranges. And with that, that's the end of the lecture on pensions and OPEB. Thank you.